seem to be of elevated importance because people are paying attention to them. But for many, many years, and still including today, it's this report, which is the granddaddy of the monthly reports. Everybody waits for this number, and I'm not even sure why, because to me, it's pretty insignificant given how completely unreliable these numbers now are. I mean, everybody is looking for a strong report as evidence that the economy is good, and so somehow we keep manufacturing these strong jobs reports. In fact, the report that we got on Friday was the 13th consecutive beat where the number of jobs created exceeded what Wall Street expected. Now, what are the odds of that? 13 times in a row? I mean, you're going to have a few misses in there just by pure chance. I mean, how could the expectation be too low every single time? I mean, it seems more likely that the government knows what the number is and they just want to beat it, and so they end up doing it. I'm a little skeptical of a streak that goes on for 13 consecutive months, especially given how weak the overall economy is. Because what's happened during those 13 months? Well, the Fed has taken interest rates from 0 to 5.25. Seems that would be a difficult environment for job creation. Also, look at all the layoffs that we're getting. I mean, tech companies are laying everybody off. Banks are laying off. In fact, we even got on Thursday, before we got this non-farm payroll number, we got the number of job cuts from Challenger. And it was another pretty big month. It wasn't quite as big as last month. They reported 89,703 job cuts. This month, it was 66,995. But that's still a lot of cuts. These are much bigger numbers. And it stands to reason that companies would be laying off workers. I mean, now they're laying off workers because of AI. But before that, they were just laying them off because their businesses are collapsing because their costs are rising and interest rates are rising and consumers are struggling. Companies have run out of money. And so they're having to cut their workforce just to reduce their cash burn. So it would make sense, right, that we wouldn't have a lot of jobs. Yet we keep coming out with these strong reports. So first of all, here is what the government reported for April. So the expectation was 178,000 jobs, and that would have been less than the 236,000 jobs that were reported for March. We came out with 253,000. So a solid beat. In fact, the range of expectations went from 140,000 to 200,000. So we came out above the high end. But there was one wrinkle. Nobody seemed to talk about it. But there was a downward revision from March from 236,000 all the way down to 165,000. It was basically a push. I think if you take the 2 months combined and you net out the revisions, it was only a beat of 2,000 jobs. But nobody really talked about the downward revisions to March. It was all the beat from April. Now, of course, I don't really remember what the expectation was for March that the government beat. But I don't know, maybe 165 wouldn't have been a beat. So maybe this isn't 13 in a row if you go back and look at the revisions. But any number that's subject to that kind of revision, again, Wall Street puts a lot more stock in this number than they should. The unemployment rate fell from 3.6 to 3.4. Private payrolls also beat, but again, subject to a similar downward revision. They were looking for 153,000. The government reported 230,000. But the 189,000 that they originally reported last month was revised down to 123,000. So that was a big number. Same thing on manufacturing. They were looking for no new manufacturing jobs created. Instead, they created 11,000. But last month's loss of 1,000 was revised to a loss of 8,000. So almost a push. The labor force participation rate stayed steady at 62.6. One number that did beat, which should have been a negative for the markets, was average hourly earnings. they jumped from 0.3 to 0.5, and the year-over-year increase in average hourly earnings went from 4.2 to 4.4. So these were hotter numbers, and the market is very sensitive to anything that looks stronger or looks like higher inflation. The bond market reacted as it had been, right? Bond prices sold off, yields rose. Gold did what it always does when we get stronger economic data, and they define hotter inflation as stronger data, which doesn't even make any sense. But gold dropped. As soon as the number came out, gold sold off by $40. But it was near a record high on Thursday. Gold was trading above 2,050 when this stronger than expected number came out, and gold immediately tanked by $40. It closed down about $30, still well above 2,000. I think we're trading about up $1 right now in early trading on Sunday night. Gold's about 2,020. And even though gold stocks initially got clobbered on the $40 drop in the price of gold, by the end of the day, they were broadly unchanged. I mean, some of the stocks actually finished positive on the day. So to me, with gold down $30 and gold stocks flat to positive or down just a little, again, that's showing me that 2,000 is the support, and gold stock traders are now starting to recognize that. In fact, this time we couldn't even get below 2,000. We had been trading below 2,000 on the sell-offs, but on this $40 sell-off, we couldn't even get to 2,000. That's how strong the market is. The one market that seemed to act different than it had been acting was the stock market. The Dow Jones, despite this strong economic data, remember, good news is supposed to be bad news for stocks, and bad news is good news. This jobs report was taken by Wall Street as good news, and it had within it, bad news on inflation, meaning bigger numbers, yet the Dow was up 546 points. That's a big move. And in fact, the NASDAQ on a percentage basis was up even bigger. I think the NASDAQ was up 2%, and the Russell 2000 up about 2.4%. So all these equities rose. And in fact, the riskiest equities rose even more. I think the Cathie Wood ARK Innovation ETF was up about 4.5%. Now, maybe shorts covered. Maybe that's what was going on. We had this stronger than expected economic news that should have been bad for stocks. Instead, stocks rallied anyway. I still think that we're going to see more downside in the stock market, because my take, and I gave this to everybody on the last podcast on Wednesday following the Powell press conference, where Powell basically threw cold water on the idea that the Fed has paused, that we're finished with the rate hikes. And then he went even further by saying the expectation that we're going to cut rates is wrong. If anybody thinks we're going to cut rates, and of course the market is certain that the Fed's going to cut rates this year because it's already pricing it in. But despite that, Powell said, no, we're not going to cut rates. We're going to keep rates where we are. We've got to fight inflation. Given the fact that that's what Powell's saying, forget about what he's ultimately going to do. But given the fact that that's what he's saying, that is a powerful headwind for stocks. So I expect them to be moving down. But I want to talk a little bit more, though, about the jobs numbers, because once again, you really got to look beneath the headlines to see these numbers, because these are not strong numbers. And again, when you're looking at the jobs report, they're counting jobs. They're not counting people who have jobs. It's not the number of people who are working. It's how many jobs the people who are working have. And so what most of these new jobs represent are people working second, third, fourth jobs. That's what they are. They're not people coming into the labor force who weren't participating and now they've got a full-time job. These are people that are already working their butts off, and now they have to work even harder to make ends meet. But if you look at the household survey, compare that to the number, again, the household survey, which I think is probably more accurate on people working, that had 139,000 jobs added. That was the lowest number since November of last year. But what really stood out this month was the jobs that were added as a result of the birth-death model. Now, I haven't really talked a lot about birth-death on the podcast recently on these payroll numbers. If you're not familiar with that, the way that works is the guys that compute these non-farm payroll numbers, they're supposed to try to guess the number of jobs that were created or lost based on new businesses that were either formed or, existing businesses that were shut down. Now, they don't actually have the data, so they kind of wing it, I guess. I'm really not sure what the methodology is. I think it's probably highly subjective, because if you think the economy is good, well, you're just going to assume that new businesses are being formed. So you have that bias. If you think the economy is bad, well, maybe you'll assume that some businesses are folding and they're going out of business. So we know that everybody in the government thinks we have this super strong economy, and that's shrugging off inflation and rate hikes. And so if you have that kind of bias, maybe that's why they keep assuming that all these new businesses are being born, when it's probably more likely that existing businesses are dying off. So that automatically means the number is going to be way off, because instead of subtracting jobs based on companies that went out of business, you're adding jobs based on fictitious companies that never really started up, but you're just assuming it. But this month's number assumed, and I got this stuff from a Zero Hedge article, just to give them a plug, but the birth-death model for April was 378,000 jobs that were added. That is the second highest ever. How is it that this economy is so super strong right now that we just had new businesses being started and hiring the second largest number of workers in history? That doesn't make any sense. That doesn't even come close to passing the smell test. And in fact, if there were only 253,000 jobs created total, yet the government assumed that brand new businesses that they don't even have proof were formed, if those so-called new businesses added 378,000 jobs, that's all the jobs. That means if it wasn't for these businesses that the government assumes were created last month, this is just 1 month of new business formation, right? Assuming they weren't existing, 125,000 jobs would have been lost. So that means the businesses that we know are operating, they fired 125,000 people, or they got rid of 125,000 jobs. Who knows how many people that represents, right? Because some people could have had 2 or 3 of those jobs. But 125,000 jobs were lost by companies that they know existed. But then they assumed that 378,000 jobs were created by companies they're guessing started up during the month. So none of this makes any sense. All these numbers, I think, are just, pulled out of a hat. And they're very likely to be massively revised, whether it's a month from now or even a year from now. They go back and they fix this because they know how inaccurate it really is. So given how wildly inaccurate these numbers actually are when they get reported, it makes no sense that Wall Street should put so much stock in this data point. So I'm going to talk, though, about some other data points that I think are more important than the payroll numbers that came out on Friday. But before I do that, we're going to take a quick break for the commercial, and then we'll be right back.